Um, I don't think this will take more than 30 or 40 minutes, and then we'll have some questions, and I know you all have some other things to do. For those of you who don't know me, I'm Gary Lemon, and I'm in the econ department. And as I was thinking about this, I made my first investment, I think, when I was 19, so probably about the age of all of you. And quite frankly, I made every mistake there was in the beginning. I got sold some stuff, which you should never do. The reason I'm doing this is because the senior management fellows said, oh, well, we really want to know is how to do some financial planning. So this is going to be a 50,000-foot, 600-mile-an-hour overview. Probably each one of these slides I could probably spend the whole hour on talking about. My specialty in economics is investments. My dissertation was how people form price expectations. I actually have some private clients that I deal with, and on the board of directors, I'm the investment chair at Lincoln Life, and we actually manage $30 billion, and we have 80 mutual funds. I do this a lot. Actually, when the management fellows said something about me doing this, I said, oh, I'll go get somebody. But the problem is I went to alumni relations, and everyone I picked or thought about, they have something to sell, right? And probably you don't want to deal with somebody who's trying to sell you something because obviously they got a bias. I have nothing to sell, right? So there's no sales pitch here. The next slide I'm going to do is in honor of Jamie Lewis, who was a former student of mine. Jamie ended up getting a job at Deutsche Bank, which is an investment bank in New York City, and she got a bonus of $30,000. And she came in storming into my office, and she was swearing. She says, I can't believe these people. They said they would send me $30,000, and they only sent me $19,834. And I go, welcome to the real world, Jamie, because they'd taken taxes out of it. So I thought this slide is in honor of Jamie Lewis. So let's assume you get a job out of here that pays $5,000 a month. So $60,000 a year. I saw somebody's contract, a senior who actually is going to get paid $5,000 a month. The contract's for. So hey, I'm rich. I'm getting $5,000 a month. Uh-oh. They start taking money out of it. Now, most of these numbers I made up, right? I'm going to talk a lot about your uncle. You've got an uncle who is very generous in some ways, but also he wants his money back. And who am I talking about? Uncle Sam. I just picked 15%. Now, it makes a big difference if you're married, you're single, how much you contribute. There's a lot of variables that go in. But for an average person, probably an average tax is $750, 15% of your, and so that's a rough. The next number, what's the next number? Social Security and Medicare. Your grandmother and your grandfather want their money. We have a pay-as-you-go system. Now, I will tell you, and I tell all my students, assume when you retire, there won't be that system. I assumed that when I was your age, and it's now manna from heaven. But your grandmother wants her money, and she wants her health insurance. And that number is fixed, right? That number is a correct number. And it's from the first dollar you earn, right? You've all gotten some checks, and you'll notice there's Social Security taken out of it. It's the same for everyone. And then there's state income tax, right? The governor of the state of Indiana wants it. Now, if you happen to work in Texas or you happen to work in Florida, there's no tax. If you work in New York State, it's probably much more than this. I just picked 4%, which is what I have to pay in general in Indiana, so I lose another $200. Health insurance, of course, this is a big variable. I asked Rebecca, who is in our office, who is single. I said, how much do you pay a month? And she said $65, which is probably a little on the low side per month. And then At DePauw University, and in most places, and I'm going to talk about this a little bit later, there's a retirement program, and economists often say there's no such thing as a free lunch. This is damn close to a free lunch. If you work at DePauw and you put 5% of your salary aside, they will give you 8%. It's like free money, right? They'll give you 8% of your salary if all you got to do is put 5% aside. So, so I just put 5% aside because I want the, and it depends on where you work and what kind of, so that $5,000 is now $3,352.50, or you only get about 2/3 of what you said. And one of the things I would tell you is assume your income is really $40,000. Plan your life. Don't say it's $60,000. Don't look at the gross. If you ask me right now what my gross pay is, I couldn't tell you. I can tell you how much I take home, but you should plan your life around how much you take home, not the top numbers. So one of the pieces of advice at the end I'm going to give you, don't look at the top number. Look at the this number right here, right? Oh, I got a pointer. And say, hey, I got to live on $3,300. The rest of it's gone. It's just gone. So I'm really making $33.52. So this slide is my Jamie Lewis slide. And I will send her a copy of the lecture and tell her to listen to the first 5 minutes. So my first advice is consider the bottom line, not the top line. Okay, so now I got through my first paycheck. This is what I call warm-up exercises. Okay, these are the things you need to do before you do anything else. And the first one is a rainy day money. Your car breaks down. You have to go to the doctor. Your TV breaks, right? There are all these, in my case, my roof needs, I need a new roof on my house. Otherwise, the rainy day is going to come right through my ceiling. So you need money. Now, how much? And I put 3 months. You know, if you're working at General Motors and you got 2 kids and the economy is going in the tank and you're about to get laid off, 3 months is probably not enough. If you're a full professor at DePauw University and you got a fairly good income, you probably 3 months is more than enough. It's something you've got to decide, but you need to have that rainy day money. Just set it aside, put it in a savings account, and then hopefully you never have to use it, but it's there so you don't have to borrow the money. Insurance. Insurance is for catastrophic events with a low probability of occurring. A catastrophic event, something you can't afford, that has a very low probability of occurring. And the first one I have is auto. If you got a car, liability insurance, right? As it turns out, if you have a wreck, you want to have it with me and you want it to be my fault. I've got liability, liability, and liability. Actually, I got over $1 million of liability, so you can sue me, right? Now, the last million, guess what the last million cost me? I've got underlying insurance underneath the car of about $200,000, but then I bought another $1 million on top of it. What do you think that cost me? Is that going to cost me a lot? The answer is $150 a year. Because why? It's a catastrophic event with a very low probability of occurring, right? Those are the things you want to, things I can't afford. My house, if my house goes down, I'm screwed, right? Because I don't have a place to live. I also, and one of the things you can tell your parents you learn, I actually have earth movement insurance, earthquake. How many earthquakes we get? Not many, but it's going to happen. Sometime, maybe not in my lifetime, right? But sometime in the near future, i.e. in the next 500 years, there's going to be a major quake in this area. And my house will probably go down. It's a catastrophic event. What's the probability? Very low. It's really cheap. I think it cost me another $30 or $40 a year. But if my house goes down, ooh, I'm in trouble. So what you want, and of course if it's a catastrophic event with a high probability, you can't afford it. You need to get out of there. And the stuff that doesn't cost you much, either whether it's low or high, why do it? I can afford this, right? I can afford to go see the doctor with my cold. You know, my health insurance is high deductibles, right? What I can't do, which I actually did, was get on a ladder. I fell off a ladder, well into six figures. And you notice there's no ill effect from my falling off the ladder. That's a joke, okay? They're still there. Life insurance. Now, I'm not going to talk about homes. I assume you're not going to probably do it. Well, guess when I bought life insurance? Guess when I bought life insurance? When, in general, should you buy life insurance? Get married is an option. I got married. My wife, Susan, who I still have, or she still has me. I don't know which way it is. Susan has a master's degree. She had a good job. We had no debt. If I kicked the bucket, notice I didn't say when, I just said if I kicked the bucket, what would have happened to her early in our marriage? Nothing, right? I mean, everything was paid for. She would have had a job. She could have gone on. So I did not buy insurance, life insurance at that point. So try to guess where Gary bought life insurance. When did I pick up a huge liability that I wanted to make sure? Pardon? Kids. When Mark was born, I went and got life insurance, right? Because it was a huge liability. Susan would have had a little bit of problems of doing Mark, and then we had Michael. And so that's when I bought life insurance. And guess how much life insurance I have now? Mark and Michael both have graduated. They both have master's degrees. They both have jobs. They both have spouses. Guess how much life insurance I have now? Zippo, right? Because I got a lot of retirement income, and you know, there's no need for me to have. As it turns out, life insurance, and I'll just spend a second on this. Life insurance, this is one of these cases. The lower the price, the better. Term insurance, and it's really cheap, comparatively speaking. So, so these are I would not do anything until I got this. These are the warm-up exercises that you really need to think about. You know, the auto insurance, you know, when you don't have much to lose and you get sued, you say, I don't care. But as you progress through your life and you get more and more things, you want to think about doing it. More warm-up exercises. Credit card debt. Oh, I was going to bring I just got a credit card bill. I pay my credit cards within 30 days, right? I just got a bill for $7,000. If I pay the minimum, it would take me 19 years to pay it off. And the $7,000, I would have to spend about $20,000. Don't take on credit card debt. It's horrible. It's absolutely horrible. Now, I have credit cards, but as soon as I get them, I pay them, right? This is not where you want to borrow money. So if you got credit card debt, get it out as fast as you can. It's bad news. Pay off all loans that have a high interest rate. Of course, the operative word is, what is high? I would say anything over 8% I would pay off as soon as I can, right? Before you start investing, get rid of your debt. Now, obviously, home loans are different, but that's something else. Cars. I'm a big believer. Cars are to get you from point A to point B and do it as cheaply as they can. Now, some people love their cars and I got to have the newest and latest, greatest thing. It's going to be the second most expensive thing you ever buy, right? A car. I mean, the house is probably going to be the most, actually, my kids' education's right up there, but a car, I mean, a house, and then cars are going to be the most. And the cheapest way, if you want to know the cheapest way to do it, is buy a bulletproof 3-year-old car with low mileage. You know, a Camry with 30,000. Let's see, this is 2013, a 2010 Camry with 30,000 miles. Because when you drive the car off, if you buy a new car and you drive it off the lot, probably the value just went down 20%. Right? It cost you, on a $30,000 car, you just lost $6,000. That smell is great, but you paid a hell of a lot for it. And of course, you know, cars are much more reliable than when I was a kid, but try to get them to last 10 years, right? The second best thing to do is buy a new car with cash. Cash is king. The third would buy it with a car loan. And the absolute worst way is leasing cars. It's very expensive. There's a wonderful article in the New York Times the other day about how expensive it is to lease cars. So be careful with leasing cars. The nice thing is you get a new one every year or every 3 years, and they smell great. But then you turn them back and you don't have anything. It's never too early to start. I love these kinds of things. You want $2 million when you're 65? I can tell you how to do it. I'm going, now obviously economists assume things all the time. I'm going to assume you return 7%. Warren Buffett says that's a reasonable assumption, and if Warren Buffett says it, it's reasonable as far as I'm concerned. So if you're age 20, most of you, if you put $510 a month aside, i.e. you contribute $275,000 total, you'll have $2 million when you get to 65, right? 8 times as much money as you put in. Now, if you start at 25, oh, you didn't have to put in for 5 years. That's the good news. Yes, I didn't have to put in that money. So I'm going to start at 25. So I don't contribute between 20 and 25. I now need to contribute $725, and I'm going to have to contribute $348, right? $348,000 is going to be my money, et cetera, et cetera, et cetera. So if I start at 50, I'm going to have to put $5,600 aside a month, which means I'm going to contribute $1 million to get my $2 million. This is what Einstein called the greatest thing in the world, compounding. Compounding. It's wonderful.
Where are you putting in this?
Actually, you know, as I was putting these slides together, I thought I should do another session, and I may, on stock markets. I mean, yeah, well, there are other places. Well, I'll show you in a second. The stock market's probably the closest thing. That's where I would put it. So the point is, the earlier you start, the better. And this is one of my favorite graphs. I don't know why I put it in. It's because I like it. Why should I invest, Erica? Now, all you need to do is convince your great-great-great-great-great-great-great-grandparents to put $1 in 1801. All right, that's all you need to do, 1801. Notice this scale is you know, this is not the normal scale, right? Each mark is up by 10 times. All right, so this is not your normal graph. CPI, Consumer Price Index, a dollar hot dog would now cost $16.48, right? I mean, gold, do not buy gold. I'm sure there's some gold bug in here, and somebody's father, mother does gold. Why would you ever buy gold? Why would you ever buy gold? It's a barren asset. Why would you buy it? Why does anybody ever buy gold? Well, now I can back up. GE, I worked at GE for a while. We bought gold and we used it for leads. Forget that. Why would an average citizen ever buy gold? Bronco? Why would you ever buy gold? It's what I call the greater fool's game. And I don't like playing greater fools. I'll buy, you know, I will pay you $10,000 for this clicker, right? If I think there's somebody a year from now will buy it for $15,000. Why would you buy a bar of gold? The answer is because I think there's a greater fool that will pay even more for it a year from now. The problem with greater fool's game is you're going to be sitting here with this clicker and I just paid $50,000 for it, and somebody says, you know, you can buy them at Walmart for $4.95. You go, holy cow. There are great examples of greater fool's games being played, and probably one of them would be real estate, right? I mean, the bubble. Why people were flipping houses. They were buying houses. I'm not going to live in that thing. I'm going to flip it because there's a greater fool that's going to come along and pay me even more. So I'm not a gold bug, right? And you know, over time, gold just hasn't done that well. Bills, T-bills, this is a very safe investment, 4,800. Bonds, 17,000. Stocks, Erica, 11 million. If your great-great-great-great-grandparents had put $1 down, you'd have 11 million bucks now. And notice, there's a fairly straight line. There's some really nasty things. I mean, oh yeah, it's straight. What about that, Gary? And go, ooh, that's the Great Depression, not so good. And there's one there, right? And remember, the scale is now 10 times, so those are not insignificant events. But you know, why do I say stock market? I need to look at these every once. Oh yeah, Gary, it's going to be all right. It's going to be all right. All you have to do is live for 200 years. I'm going to spend quite a bit of time on this, not this particular slide, but do not share with your uncle. And of course, I'm talking about Uncle Sam. I'm just going to talk about IRAs, and I've actually got slides about other investments. I've got $4,000, all right? And I'm going to invest this $4,000. There are two ways to do it. One way is to do it after taxes, and let's just assume I'm in the 28% tax bracket, which most middle-class Americans, that's where they'll end up, in the marginal rates of 28%. Which means after taxes, I'm going to have $22,880. Okay, you with me? So I started with $4,000. DePauw gave me $4,000. I now pay the taxes. I got $2,800. I'm going to put that in an investment account. The other thing I can do is put it in an IRA, which means all $4,000 goes into the IRA. Now assume, and my uncle says, hey Gary, you know, you're going to owe me eventually, right? This is now tax-free, but you're going to have to pay taxes on it eventually in an IRA. So I'm going to owe my uncle $1,120. And I put it in at 20 and I pull it out at 65 and I pay him $1,120. Made some assumptions there. What did I just get? An interest-free loan. My uncle said, hey Gary, we're going to let you have the money, pay me later, 40 years later, 20 years later. I go, ka-ching! The other thing that happens is, so it's an interest-free loan. Also, I get to use his money and I get to invest it and make money on his money. All right, so there are two advantages. Number one, I get to keep the money I may eventually owe my uncle, and I also get to invest it and earn money on his money. Give me money, let me earn interest on your money, yay! And it makes a hell of a lot of difference. Okay, so the top line is tax-deferred investing. If I do this over 40 years, I put $4,000 aside in an IRA, I end up with 1.6 million. If on the other hand, I put it in, I take it after taxes, I put 2,800 aside, I end up with 604,000. That's why you do IRAs. That's why you do IRAs. And you'll notice those lines start diverging, right? I mean, they start close. If you only do it for a year, hey, it didn't save that much. But over time, those lines make a big difference. And I'm going to show other slides, and I won't go into the same detail, but this is why you do KEOs and 403Bs and 401, tax-deferred stuff. This is more about retirement. 401Ks are for for-profits. So if you work for General Electric, you'll have a 401K. What does it mean? It means it's a part of the IRS section. It's Section 401, Part K. DePauw University, not-for-profits or 403Bs, same thing. And I've already told you, there's free money there. In general, there's free money. There was free money when I was at GE. There's free money at DePauw. Put 5% aside, they'll put 8%. So my investment, which is tax-free, goes in at 13% if I just do the minimum. And if you don't put 5% in, what happens to the 8%? DePauw keeps it. Too bad. So sad. It's our money. So you'll have a hard time getting an economist to say it, but it's almost free money. It's almost free money. unless you're just right on the edge, you really need to do it. And this will vary from, at GE, they only, it was dollar for dollar, up to, I think, 6%. I'm sure it's changed dramatically. And once again, this is pre-tax money, which is, I've already told you about pre-tax money. This money also accumulates tax-free. So if you put the money into a taxable account and got 8%, you owe tax on it. You may only earn really 5 or 6 after tax. In an IRA or KEO or any of these, it'll accumulate tax-free. KEOs and SEPs, what are they for? People who work for themselves, doctors, lawyers. SEPs are easier to administer. KEOs are a pain in the cartouche from a technical standpoint. But if you work for yourself, you set up your own business, you'll probably have a SEP. And you can set aside 25% up to $50,000. So if you earn $200,000 working for yourself, you can throw $50,000 of that away. You can invest $50,000, right? And your taxable income will drop to $150,000. Okay, this is important. Know what you're doing. You gotta, what is your objective? You know, I've been talking about retirement, which is a long ways away, but you know what I think I'm going to do is I'm going to buy a car next year. You got to, in that case, you got to put the money aside, right? You can't be investing it because the stock market's pretty volatile year to year. So know what you're doing. If you're saving your money to buy a house in 3 years, you're sending your kid to DePauw University in 5 years, you want a new couch in 2 years, that's a whole different ball game. You know, but if you just had a kid and you say, I'm going to send that kid to DePauw in 18 years, you have a much different set of things that you can look at. Or if you're saying I'm saving for my retirement 40 years, you know, it's a whole different ball game. So sit down, what am I trying to do? Is it short run or long run? Short run, you can't take any risks because it's just not going to work. Long run, okay, I can now assume so much risk. The other thing, I grew up on a farm, and there were farmers who bought wheat futures. They had no idea what they were doing. This is life in the fast lane. I mean, they're highly leveraged. It was like, holy cow, do you know what you're doing? And they go, no. Enron. People tried to explain to me what Enron was doing. I don't get it. I got a PhD in economics. I don't understand what you're doing. Well, the reason I didn't understand it was fraud. So it's important, if you don't understand the risk, don't do it. Just don't do it, right? Because there's nothing out there. I mean, people come to me periodically and say, yeah, you want to do this? And I go, no. Not really. I don't understand it. That doesn't sound quite right. Anybody, hey, I'm going to get rich quick. I go, I like being poor, so I'm just going to count me out. I'm just going to say a little bit about houses. I own a house. I've owned a house since I was 29. I bought my first house when I was 29, which is really scary, right? I went in to sign for the mortgage, and the guy said, this is a 30-year mortgage. And I go, oh my God, if I'd paid every month since I was born, I'd still owe on this house. I could easily flip. Don't think of homes as an investment. Think of it as a consumption item, just like buying a shirt, buying garlic cheeseburgers, buying cars, buying couches. It's not an investment. It's not an investment. If you look at historical returns on houses, it just keeps up with inflation. Now, I'm sure you can go, but I know somebody that doubled their money. Yeah, okay. But on average, it just doesn't happen. So I think of it as a consumption item. I don't think of it as a good investment. I own a home because I want a home. Just like I want a car, and I want a shirt, and I want some pants, and I want a garlic cheeseburger. It's a consumption item. It's not an investment. There are tax advantages to do it. My uncle really wants me to live in a home. And so I did, and I bought a house that was too big, and because you can deduct mortgage interest, you can deduct the property tax. There are certain real advantages. Also, any money you make is not taxable. There's capital gains if you roll over. I mean, there are real tax advantages to owning a home. So, but it's not free to move, right, Sandy? It's not free to move. It's a pain in the cartouche. Number one, you got to pay a realtor probably 6 or 7%. So there goes 7%. You got to have a home closing. You got to do inspections. You got to hire a mover. So my advice is don't buy a home until you think you're going to live there for 6 or 7 years, and then maybe you'll break even.
What about like apartments and condos?
Well, yeah, that's what you got to do, right? I mean, you got to live somewhere in an apartment. I mean, I lived until I was 29 in apartments.
So like,
Because I knew I was going to move.
better than owning a condo?
I would not own a condo until I knew I was going to stay there, right? And my rule is 6 or 7 years. If you're going to say you're going to be there for 6 or 7 years, okay. But once again, it's a consumption item. I don't think I'm going to make any money at it. A rough rule of thumb is try to have at least 20% down for a down payment. See, this is the rainy day money over there that you're trying to put aside. And this is a very rough rule of thumb. Take your annual income, multiply it by 2.5, and that's what you can afford. So you can take you, and if you got a spouse, a partner, multiply your income by 2.5, and that's more or less where you should be. You start getting outside that, you're stretching yourself. Now you can say, well, I'm going to go, well, okay, if you're pretty sure, but be careful if you go beyond that. Anytime, once again, Erica, I'm a big stock market guy, okay? That's where I made my money. The stock market's been very, very good to me. Not every year, not every month, not every day. There have been months and years when it didn't, but on average, and these are the returns, right? Ah! This is what I want. 12.6 is, now this, and I'm a big believer in small companies, okay, and we don't have enough time for me to tell you why small companies are where to be. Now, what's this number? This is the risk, right? You want this number to be small. There's no such thing as a free lunch. If you want 12%, you want small companies, you're going to have to take a lot of risk. You know, that's standard deviations. I don't want to talk, yeah, I don't want standard deviations, right? Those are standard deviations. I mean, those small companies are all over the place. Some years are going to be good, some years are going to be bad. That's why you can't do it in the short run, right? You got to be there for the long run, because you may hit bottom. And large companies, a little less. Long-term government bonds, 5%. You're going to do bonds. Not as risky. Look at the risk. It's been cut in half from large companies, and a fourth for small companies. U.S. Treasury bills. Economists consider these risk-free. And if inflation was here, probably inflation's average 3.7. So in real terms, you're nowhere. You're nowhere. T-bills, if you buy a T-bill, just assume you're going to keep up with inflation. And right now, you're not even keeping up with inflation. They really suck. That's a technical term. So every time I get a little discouraged about the stock market, I look at this chart. There's some bad years in there, right? The Great Depression's in there, World War II's in there, Vietnam's in there. There's some bad stuff in there, and we did okay. There's a government shutdown. Oh, we got another one in there. So, I'm basically an optimist, so I think these things are going to work out. Things to remember. No free lunch here. I said there might be a free lunch some other earlier today. Not. For an economist, risk is a bad, right? There are goods. Right? I want a garlic cheeseburger, I got to pay for it. I want a shirt, I got to pay for it. These are goods. You know, cars, I got to pay for. Bads, I will pay to get rid of, right? I don't like spiders and snakes. That used to be a song when I was your age. It's a bad, right? Skunks, I'll pay to get rid of them. Termites, get rid of them. I'll pay to get rid of them. Bads are things I don't want. Risk? It may go down. It may go down 30%. How do you entice somebody to do that? How do you entice somebody to get out there when there's something bad could happen? Economists would say, pay them. Make a higher return. So risk and return are related. The more risk you take on, the more return you should make on average. On average, right? There's going to be some really bad times, and you may be the one with the really bad time. Sorry, you just lost. That means the winner is just going to win more, right? So no free lunch here. If you want a high return, people always come to me. Oh, I want a lot of return. And I want no risk. Me too. This doesn't happen, right? It doesn't happen over long periods. It just doesn't happen. This next one, I love the next slide I'm going to show you. I just love it. Longer holding periods equal lower risk. That's why I told you, you got to know if you're short run or long run. If you're short run, long run, right, there's still variation, but it's not as great. So longer holder periods equal lower risk. So that's why you have to sit down and say, do I short run or long run? If it's short run, man, I'm scared. I'm scared. You know, my father, when he got older, I was helping with his investments, and he just said to me, Gary, I'm worried about the return of my money, not the return on my money. And I go, yeah, Dad, that's right. Because he didn't have time to take out these variations. So in 2008, I got him literally out of everything. He didn't suffer through the... Unfortunately, Gary didn't follow his own advice, right? And I stayed and I right down the tube. But it's back. It's back. Dollar cost averaging is something, it's really important. And I'll show you an example here in a second. And then rebalancing is also important. Here's a slide why short runs are really scary. If you are investing for 1 year in the stock market, I'm going to do the stock market. The best year made 52%. Ka-ching! Worst year lost 26. Ugh. So on the average, right, I'm right around 10, 12%. But if you invested for 1 year and you lost a quarter of your money, you go, whoa, not so good, right? What if I did 5 years? So what was the best 5 years? 28.55. Lost 2.36. Not good. 10 years. There's no 10-year period from 50 to 2005. There's no 10-year period where you ever lost money. Now, making 1.24 a year ain't that good, but at least you didn't lose, right? Look at those bands. They start collapsing on them. And so, in a 25-year period, the best was 1724, the worst was 794. Now, I'm not saying that's a lot of difference, but it's better than losing money. So you see those bands. So that's why I say look at short-term, long-term. If you're doing short-term, it's just too damn volatile. It's too damn volatile for me, and I'm pretty much a risk taker. But if you're in the long-term, and I'll tell you how to take care of that with the next slide. I'm about to say this is one of the most important things I'm going to do. So those of you who have gone to sleep, wake up! Wake up. This actually is amazing. I've got $1,000. I'm going to buy a stock, and it happens to be selling for $10. So I'm going to purchase 100 shares. Holy cow. Next time I go to buy it, it's at $5. I buy 1,000 shares, it's $5, and of course I get 200 shares. What's the average price of my stock? You're looking. Cheaters! You're supposed to say 750, 750. 10 plus 5 divided by 2, 750. Wrong, dragon breath. I got $2,000 invested. I got 300 shares at 667. This is what's called dollar cost averaging. Now, there's only one trick to this. I mean, the trick, of course, is I put the same amount. If I bought 100 shares, right, it would be 1,000, but I bought 200 shares. Easy said. What did I have to do in order to do this? I had to buy when the market was down. The stock went down by half and I bought more? What are you, an idiot? People want to buy when the stock market's up. Buy low, sell high. Went down. Buy low. Actually, people say to me when the stock market goes down, oh, Gary, aren't you depressed? And I go, no, I get to buy more, right? It's cheaper. I mean, buy when it's cheap. I am a contrarian when it comes to investing. When everybody else is rushing in, I'm coming out. And when everybody else is going out, I'm going in. Right? I mean, buy low, which means when the market's down, I'm happy. Well, sort of. Now, if I'm selling, I'm not so happy, right? Now it's a whole different. Now I'm selling. I want to sell high. If the market's down, I'm not so happy. Now, the nice thing about retirement programs, the university, right? Twice a month, I put money in, right? I have no control over it. I can't say, no, don't do that. Right? So I get dollar cost averaging, and it's wonderful. It's absolutely wonderful. And if, let's say your grandmother just calls you right after this meeting and says, look, I'm going to give you $5 million. What you want to do is you want to spread, and you decide to put it in the market. What you want to do is put a little in every month for the next 36 months, for example. So is the market going to be up, going to be down? I don't know. Nobody knows. Anybody tells you they know, forget it. But you'll buy some at high, some at low, some at high, some at low, some at high, some at low. And on average, you will get this dollar cost averaging. So do not, what I call, be a plunger. Put it all in. Because more than likely you'll put it in, or at least my luck is I'd put it in exactly at the wrong time. Rebalancing. You know, what you should do is decide, and once again, I don't have time to do this today because I'm almost done, but you know, you should decide how you should want to allocate your money. So I'm just going to do a very crude example. I'm not suggesting this at all. That I want 60% in stocks and 40% in bonds. That's just my, the way I want to spread my money. Now, let's say the stock market takes off. And all of a sudden I look, I got 70% in bonds, 70% in stock and 30% in bonds. What would a rebalancer do? Sell the stock and buy bonds. i.e., buy low, right? The bonds are down, sell high when the stock's up. If the correct allocation is 60-40, now we got to argue, is it really the correct allocation? And by the way, that's not the way I allocate my money at all. I got an allocation model, but it's a little more sophisticated than that. And actually, I don't own any bonds right now. Well, that's not quite true. I own very few bonds right now. I think the bond market is just, it's really scary because interest rates are low. And when interest rates go up, and they will go up, people are going to get screwed. I know 5 years from now, people are going, how could I be so stupid to be in bonds on October 2nd of the year 2013. I'm trying to, nobody told me. Well, I'm telling you, it's stupid. You can actually, rebalancing will reduce your risk and return. There's some great articles about this. Rebalancing forces you to buy low, sell high, because if something takes off, you're going to be selling it because you've got to get back into the balance you wanted. And most returns that people who do stock picking, they don't do it because of the stocks they pick. They do it because of the allocation they do between various commodities or various bundles. I told you I do this gig at Lincoln. let's just say the market's up on average 10%. On average, right, we got to make 10%. Now, some people are going to make more than that, and some people are going to make less. Now, the people we got at Lincoln, you got to make a living. Or people who are picking stocks got to make a living. And they, in general, I'm going to teach, new vocabulary word for some of you. You hear people in investment always talking about basis points, 50 basis points, 75 basis points, 100 basis points, 100. You go, what the hell's that? It's simple. 100 basis points equals 1%. 50 basis points would be 0.5 of 1%. 10 basis points would be 1/10 of 1%. 200 basis points would be 2%. Now you can talk like an investor. In general, they charge 100 basis points, i.e. 1%. So on average, they're going to make 9%, right? You see what, if everyone is in this market and you're playing the game and everyone charges 100 basis points, on average, they can only make 9% or 9%. So on average, they can't beat the market. Right? And in fact, you got to do it damn good just to get back up to 10%, right? You got to beat the market by, you're going to have to make 11% just to break even. You see what I'm saying? It's really hard to beat the market consistently by 100 basis points. And in fact, you can't do it. But that's the, how many more slides I got? 3 more, okay. I'll start. Look, what I do for a living is really simple. I'm sorry. I got a PhD and this is simple. 2 things to remember, cost and risk. Guess what? What do you want to do with your cost? Cost is the word I'm trying to say. Keep it low. You got a PhD to tell me I want low cost? Yeah, and as it turns out, some of the best investment vehicles are low-cost vehicles. You don't get necessarily what you pay for. In fact, in general, you don't. So keep your costs low. And over long periods of time, 50 basis points, notice now we can talk. 50 basis points makes a hell of a lot of difference. 75 basis points makes a hell of a lot of difference when you compound it. So keep costs as low as possible. Long periods of time, lower costs can have a profound, if you start doing this over 40 years, and some of the best options also have the lowest cost. I have most of my money in a place called Vanguard. Vanguard's wonderful. And they're also the lowest cost providers. And nobody beats Vanguard when it comes to cost. Risk. Okay? Don't let anybody talk you into anything risky that you don't understand and you don't like, right? My risk tolerance is different than yours. This is the hardest thing for an individual to decide. In general, young people should be more risky than I am, right? Because you got longer periods. We did that chart, right? Where the variation's everywhere. You have a longer planning, in general, a longer planning horizon than I do, at least for retirement, maybe not for cars. Do not take more risk than you are comfortable with, and diversify, 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 right? What you want in a stocks or your portfolio is you don't want, here's another nasty term, correlation coefficients of 1, right? If you don't know what I said, don't worry about it. You want things that move in different directions at different times. And so I have a portfolio, probably 6 or 7 different things. The correlation coefficient of 1, they move exactly the same. They'll all be positive. I mean, what you want is a -1. That would be the optimum. Then risk would go away. But they tend to move together. I have a lot of foreign stocks. I've got small companies. I got big companies. I've got a bunch of stuff. And the correlation coefficient's positive, but it's not 1. So I get diversification. So don't forget diversify. And what do? I do index funds. What I tried to convince you of earlier is I can't beat the average, so I'm going to join it. And I'm going to do it really cheaply, right? Some index funds charge 7 basis points. What's that? 0.07 of 1%. It's nothing. They're doing it almost for free. It's like they love me. Now they do it for everyone. because they don't have to try to pick stocks. All they're trying to do is, hey, we'll match the average. And I go, just match the average, damn it, because nobody else can beat it. Anything you want to do that you should be doing, you can do with an index fund. I can do small stocks, I can do big stocks, I can do foreign stocks, I can do commodities, you know, I can do anything. There are index funds that do them. Right now, most of my money's in what are called ETFs, exchange traded funds, and they're even cheaper than index funds. There's some advantages, there's some disadvantages to them, but right now, they're index funds, only they trade on exchange. That's the only difference. Well, there's some other minor differences, but ETFs are what I invest in. So index mutual funds, ETFs. Okay, in summary, I went a little longer than I thought it would, but less than an hour. First thing I told you is consider your take-home pay your pay, right? Don't forget the $5,000. Think about the $3,500 and make your living arrangements according to that, right? Make sure you do your warm-up exercises, get a rainy day money, you know, buy insurance that you need, cover yourself with protection, not life, but other things. Remember the wonderful thing about compounding. Compounding is wonderful. Even Albert Einstein was impressed with compounding. Make sure you know your objectives. What are you trying to do? Remember, if you're trying to do something for 2 or 3 years, you'll come to a much different decision than if you're trying to do something 20 years out. Right? If you're trying to buy a car 5 years from now, probably the stock market's not where you want to be because you saw those variations. So know what you're trying to save for. For the long term, for long periods of time, the stock market has been very, very good to me, right? I have literally lost more money than I make at DePauw University in 1 month on the stock market. So not every month has been very, very good. But there have been months that I made 3 times as much money in the stock market as I do teaching here. And so you got to be ready for that, though. And what would be here's what some people did. And 2008 was horrible. 2008, if you don't remember, sucked. Wherever you were, it sucked. What do you think most people in the stock market did? Unsophisticated investors. They bailed out. They bailed out exactly at the wrong time. Oh my God, it's down, it's down. He went down another 10% this week. Oh, another 10, oh my God. I'm out. Oh my God, it's up 20% this week. Oh my God, right? I wrote it down. I kept saying to Susan, I kept saying, we're riding the bull down. We're gonna have to ride the bear back up. No, I did it wrong. I'm riding the bear down, the bull up, right? Remember, if you're going to do investments, you gotta have a contrarian investment philosophy. The last story I'll tell you, I was sitting in a meeting at Lincoln up in Fort Fun, Indiana, Fort Wayne, and we brought in these professional money men who came in, and every one of them said, buy Apple. We're in love with Apple. We are buying Apple like crazy. We're buying Apple. Next guy comes in, buying Apple, buying Apple, buying Apple. Next guy, buying Apple. These guys have millions of dollars and they have scores of people doing research. I leaned over to the guy next to me and guess what I said? I'm shorting Apple today. And all short means, if anybody ever says they're short anything, investments, if you're short Apple, it means I want it to go down. I make money on the way down. Because everyone was rushing into Apple. See, how has Apple done recently? It's sucking, right? Because everybody rushed in, and I really didn't short Apple. There are reasons. Shorting is really risky. Okay, I'm done. No more, no más. Anybody have any questions? Yes. Thank you. I would like, Sandy is going to pass out something. Just fill it out. You don't have to put your name on it. It just says, how did you find out about this? I'm always interested in how students find out about such things. I had well, tell me how you found out about this, and then just things that you particularly liked, and then things you go, I thought you were going to do X, Y, Z, and you didn't, or I wish you would have. Bronco?
What are some of the best sources you use to understand a company better, as well as its risks, especially if it's an industry that you don't understand?
Well, there's something called Value Line. Value Line, and it should be, our library should have it, I don't know. And if you're looking at mutual funds, the correct answer is Morningstar, if you're looking at mutual funds. Notice I don't take either one of them, I don't read either one of them. They're great on history. If you want to know what the stock market or what the stock has done or what they do, it's a wonderful source. You know, there's a page, and if you want to get into more sophisticated stuff, you're going to have to go somewhere else. But if you just want a real fast page summary, but what they're good at is telling you what happened, but their crystal ball is not. Value Line, I think they rank stocks 1 through 5. 1 being the best, 5 being the worst, 3 being an average. And guess what? Their 1s don't do much better than their 5s. So they're great on looking at history. Same thing is true with Morningstar. Morningstar is absolutely, actually I'm going to Morningstar in a week but they're great on history, not so much on the future. Does that answer your question? Yeah. Cameron?
So I know when school ends, we have these good things to look forward to, school loans. What is the timeline we should try to pay them off?
Well, I don't know because I don't have a student loan anymore, and I'm not. What interest rate they're going to charge you? Yeah, see, that would be the thing for me is if they're charging you 5 or less %, I would just pay it off slowly. If it's more than 5, I'd try to do some double payments. Now, you know, if inflation shoots up to 12%, that 5% loan now, or the 6% loan looks really well, good. But you know, inflation's so bloody low now that I borrowed, in 8 years of college, I borrowed $1,000, and they charged me 3% interest. And so I paid it off as slowly as I could, right, because it was 3%. But I don't know. Does anybody know when you graduate? I assume the loans are interest-free now?
I think it was like 3 point. They talked about raising it up to like really high.
Yeah. Yeah, I don't know where. I mean, the rule I gave you was anything over 5% I pay off. Now, now that's not a hard rule, right? Because if inflation shoots up to 8%, then, oh, hey, that 5%. I mean, I had a loan once on a house. Inflation, my loan was 8%, which sounds like a lot, but inflation was 12%. And so they were paying me in real terms to borrow money from them, 4%. And they kept saying, oh, come on, don't you want to pay off? We even canceled 10% of the loan. I go, no. Thanks for thinking of me, though. No. Anything else?
Yeah, I'm interested in credit. Should we start now?
Excellent question. I have a son. He didn't. He tried to get a home mortgage and he couldn't. You need, by the way, protect your credit rating because you say, I don't need, my dad is rich, my grandparents, I don't need money. They'll look at that to give you your auto insurance. I mean, they look at those things for a lot of other things other than giving you a loan. So yes, I would get a credit card, pay it off, don't use it as credit, pay it off as fast as you can, but start establishing a credit rating because it isn't easy. And then when Michael went to try to buy a house, he couldn't get one. I promised to co-sign the loans. You know, and they go, no, no, no. And I go, what? So yes, I would try to establish a credit history. Just pay off the damn loans. I mean, you know, just use it as cash. You know, think of it as cash, and as soon as you get the bill, pay it instantly.
So that looks like you know, I'm like just a first at it right now. So does that look like buying a coffee?
Sure.
Just use it for coffee?
Sure.
Something like
Just pay off your bill. I mean, what they'll look at is, do you pay your bills on time? And you know, the credit ratings are fairly sophisticated, and I really don't know. But what they look at is what kind of credit line you have and how much you're utilizing of it. So, you know, if you got a $5,000 and you're only using 500 of it, it's much better than using 2,500, paying it off. But pay it off. Don't. Anytime you get a bill, pay it. Because if it gets in your credit rating and the score goes down, all of a sudden your car insurance goes up, your house insurance goes up, and you can't get a loan. Right? So, anything else? One more. And then I will excuse you all, and then those of you who want to ask me something else, come on up. So this is the last one. I told you I'd get you out at 8, and it's 8.
Resources at DePauw, if you want to talk to people about financial planning after DePauw, what resources do you have?
So, I'm sorry, ask me again.
Do we have the opportunity or like the resource to go and talk to someone about our specific planning after DePauw? Is that available?
On campus, I don't think so. I mean, obviously there are people who make a living doing this, right? And if you're going to get a financial planner, get one that's fee only, right? They're going to charge you a fee because, you know, if I'm a life insurance salesman, you come to me, I'll help you with your financial planning, or if I'm a mutual fund seller, I'll help you with your, but I got to buy, and I'm not saying they're dishonest. I'm not saying, if you go to a stockbroker, none of them are dishonest. They do it because they really believe it, but they're going to push their product, right? You want somebody that has no interest in, all they're interested in is helping you maximize whatever you're trying to do.
So you don't think like Jenny or anyone in those departments would
I don't, do you know, Sandy? Does anybody do any financial planning? I don't think so. Come see me. I'll do it. I'll do it. You get what you pay for, though. Free advice, free, or I'll give you double your money back after you don't like it. Okay, thanks, guys. If you have other questions, hand Sandy the sheets. I'm just curious.